Hello everyone. Today we are going to analyze the Kotak Emerging Equities Fund. It has an AUM of about 52,000 crores and it charges expense ratio of 0.32% for the direct version. Let's quickly dive into the benchmark analysis. And today what we are going to learn from the analysis is how important the factor betas and the risk sources play in analyzing a fund and also dissecting the returns of a fund and see what the fund manager has been doing since the inception of the fund. So let's start off with a quick performance check, right? So I think Kotak Emerging Equities Fund has beaten clearly the Nifty 50 index as well as the Nifty Midcap 150, which is the suggested benchmark here. So from the suggested benchmark itself, you can kind of guess what type of fund it is. So it is not called as a mid cap fund. So it is called as a emerging equity fund, which it's kind of like a bit creative, right? So it's not called as a mid cap fund, but you can kind of quickly understand that okay, so this is a correlation of 0.97 to the mid cap 150 index. So it must have a lot of mid cap and small cap stocks in it, right? So for now, let's take Nifty 50 as a benchmark, and in a few minutes, I will also change the benchmark to the Nifty Mid Cap and analyze the style exposures of this fund. So now to dissect the risk, where the risk is coming from for this fund, we will get into the return-based factor exposure analysis. The One of the main things of the advantages of return-based factor exposure analysis is it goes back in time and sees what the fund manager has done with respect to multiple factors. So here you have multiple asset classes. So you have Nifty 50, which is proxy for equities. You have bond index, currencies, and commodities, and you have the five well-known equity factors like value factor, size factor. And what you see here is super interesting. You can even forget about the company or the fund name and quickly understand what the fund has been doing and what type of stocks or where the returns or where the risk is coming from by quickly analyzing these four charts. So you can see that the beta to Nifty 50 is being consistent, so it's around zero point 0.9. So on average, I think it should be around zero point 0.9. Currently, it's around 1. The most interesting thing is the consistent size exposure, that is the size factor exposure. So just by looking at these two charts, I can kind of conclude that okay, it has a consistent size exposure, so it must have some small cap. It must have a lot of small cap and mid cap, and also a bit of large cap equities in this fund. So once we come down, this gives us an even better snapshot of the risk of this fund, right? The risk sources of this fund. So let's just quickly take 2014 as an example, right? So 45% of the risk is coming from Nifty 50, which is the benchmark we have chosen, and 53% of the risk is coming from equity factors. So you might ask, okay, what is this? But what equity factors do you mean? That's what we clearly saw here, right? So the equity factor exposure analysis, but we have also dissected the equity factors into the five factors that we have shown here and show you how much each factor is contributing in percentage terms. So the 53%, out of the 53%, you can see 45% of the risk is coming from just the size factor, right? Another kind of like a confirmation that this has a heavy size exposure. That means that it must have mid cap and small cap equities in the fund. So now we understood, comparing it with Nifty 50, which is not an appropriate benchmark to compare this mid cap fund against, right? So I will change the benchmark to the mid cap 150. So I've already loaded up the benchmark here, and again do the same return based factor exposure analysis and see what changed. Can you guess what changed here? I'll just give you a hint. All right. So the size factor here has been diluted, right? So previously, you can see that the size, that was a heavy size factor exposure, right? So on average, it was around 0.8, sometimes 1, 1.3, right? But here the size factor is almost on average, it's zero. Why that's the case? The reason is we have chosen a mid cap benchmark. So this covers this covers almost all the risk, right? Because it's a mid cap fund. So the risk is not going to the size factor. And that's what you also see here, that 95 percentage of the risk is coming from the benchmark that we have chosen. So previously, the equity factors played a huge role because Nifty 50 was the benchmark. Now, the mid cap covers all the risk, right? So I think that covers the written based fact exposure analysis and how useful it is to understand the risk, the historical risk, and what the fund manager has been doing, and understanding especially the style exposures the fund manager uh, has invested in the past. Now, let's quickly see whether the fund manager has generated alpha. It is an active fund, and comparing this to a benchmark, which is the Nifty 50, not Nifty 50, Nifty Midcap 150, we can see that out of 6 years, the manager has generated four out of 6 years, the manager has generated outperformance and also produced alpha in 3 out of 5 years, especially in 2021, 2022, and the current year. And you can also see the consistency of the alpha. So this is not like a huge track record, right? So we are just looking at the last 6 years, basically. uh, but still, you got to give kind of like credit where it's due, right? The last 6 years, if you analyze it, it has done relatively better than the Nifty Midcap 150. Most importantly, the regression analysis that we saw previously, right, the written base factor exposure analysis, the R squared, which tells you the explanatory power. If you are into statistics, you might have come across this term called explanatory power. It's around zero point 0.9. So 1 means it can explain it perfectly. So zero point 0.9 means it's high. It's very high enough the returns can be explained by the model that we have chosen. The model is basically the factors, the asset class factors, and the equity factors that we have chosen. Now, finally, to conclude, let's quickly compare this fund against in terms of performance, fees, how different it is from a fundamental perspective, and also the overlap analysis of this fund. So I think we already saw that the equities emerging Kotak fund has outperformed the mid cap fund consistently here, even from a performance wise. If we quickly go into the factors, I think the same kind of story follows here, right? Because it's the same factor exposure analysis. We can see a heavy size exposure for both the mid cap 150 benchmark as well as the emerging fund, and this also helps you understand the risk, the betas, right? So that we saw in on a rolling basis. Now it's just the last 5 6 years history. When it comes to the annual fees, this is a bit interesting, right? It is, I would not consider this as super high when you compare this with the mid cap 150 benchmark. So it's just charging you like 0.5% extra, which is not 0.5%, 0.15% extra, which is not a lot compared to the benchmark, what the benchmark is charging you, right? So seems to be relatively on a bit lower side, but you have to still understand that this active fund charges higher than the benchmark, right? And when you look at the Sharpe ratio, so we already looked at the performance, right? That's generated consistent alpha, and you can see that it has generated more CAGR as well as with lower volatility, and hence you see the higher Sharpe ratio compared to the Nifty Midcap 150. So a while back we kind of saw the return based factor exposure analysis, and I mentioned how you can like kind of dissect the returns and see where the returns are coming from. So that is from a return, so as the name says, right, there is a return based factor exposure analysis. Now we are looking at the style boxes, which also gives you another aspect, gives you another kind of a view into the fund from a fundamental perspective, not from a return perspective. So what we are showing here is the value from a valuation perspective, it's on the higher side. But most importantly, it's a mid cap fund, right? So when you compare this fund against Nifty 50 as benchmark, it's on the lower end. So that means that again, it consists of mid cap and small cap stocks in it, right? So the kind of story that we portrayed or that we mentioned a while back again follows here, which is good to see. Finally, one thing to understand when you compare this to a Nifty mid cap, it has 70 stocks, which is not too concentrated when you see the other concentrated funds, which has 20 or 30 stocks in it. But when you compare this to a Nifty mid cap benchmark, it is very low, uh, but still quite diversified enough for this fund with 71 stocks. And in terms of overlap, so it has 71 stocks, 46 stocks are overlapped. And when you account weightage, that is the percentage of the overlap stocks into account, you can see 32%. There's a 32% overlap between the midcap 150 benchmark and the Kotak Emerging Equity benchmark. I think that sums up the video and sums up the analysis of this Kotak Emerging Equity Fund. I hope you enjoyed it. Thanks a lot for watching. See you next time.